Hello everyone. In this week we will study lecture 6 in Managerial Finance. In this section we'll talk about the basic concept of option and Black-Scholes option pricing model, the put and call parity. And also we are going to introduce cost of capital, which is weighted average cost of capital. First, we look at what is a financial option. So an option is a contract which gives its holder the right but not the obligation to buy or sell an asset at some predetermined price within a specified period of time. So we can say the option could be a call option and a put option. So the call option gives the buyer the right to buy a certain amount or shares of a security, while the put option gives the buyer the right to sell a specified number of shares of a security within some future period. Now we talk about how to price an option. Now we introduce a little bit about binomial model. So the binomial model is similar to we learned like a decision tree. For example, we have a stock current price is $27. In next 6 months, the stock can be either going up or go down. So if the stock go up, the factor is 1.41, and they go down, the factor is 0.71. So the assumption is the stock option is going to expire in 6 months. And the exercise price is 25, while the risk-free rate at the market is 6%. So the current price go up. So the price in next 6 months is going to be $38.07, which is the current price times the factor 1.41. So following the following steps, we're gonna write one option and buying N shares of stocks. So we make a portfolio that the portfolio is going to have the following payoff. So the stock going up is going to the number of shares times the price and the go up factor minus the call option, and the stock going down, the number of shares times the price and times the factor to go down, and the payoff of the call. So we set these two conditions equal, and so for the number of shares we got like 0.69 shares. So the hedge ratio is 0.69 with riskless payoff. Okay, the riskless portfolio is constructed by buying that N shares of stock It doesn't matter the price going up or going down, the portfolio's net payoff will be equal to $13.26. So the riskless payoff earned a risk-free rate of return. So now we go to the multi-period. So the binomial model basically is only a two-period model. The Black-Scholes model extends that binomial model to multiple periods. So based on that, we have the option pricing model as follows. And for more details, please read your textbook and the PowerPoint slides provided in this week reading and study folder. Next topic is about the put and call parity. So the put and call parity is that we can construct a portfolio with a put option and the number of shares of stock, and is the value or the payoff of that portfolio 1 is going to be the same as portfolio 2. The portfolio 2 is constructed by a call option and the present value of exercise price. So we construct these two portfolios and do the analysis of the portfolio payoff at expiration date. Okay, the price could be less than the exercise price, and the price could be greater than exercise price. So we do the analysis based on these two conditions, and say portfolio 1 and 2. The total payoff at the end of the time period. So we can see that if the price is less than exercise price, so the total and payoff is X. If the price is greater than the exercise price, the payoff is PT. So we can get the put-call parity relation, which is the put is going to be the call plus the present value of exercise price minus the stock price. The last topics we're going to talk about the determination of weighted average cost of capital. So the weighted average cost of capital is going to include calculation of after-tax cost of capital, after-tax cost of debt, and the cost of preferred stock, and the cost of common stock. So the cost, we can see that in the column 1, and the cost of debt is 7.05%, and the preferred stock is 10.94%, and the common stock cost is 12%. And the company, the total asset is composed of these three different components. So the 30% of the total asset is debt, and 10% is preferred stock, and 60% of common equity. So based on that, we do the calculation, and we get the weighted average of capital using the following formula. So the is a sum up of the weighted average cost of capital is about 10.4%. Okay, what I wanted to mention is that there are three ways to determine the cost of equity. So the cost of equity, you could use CAPM, we learned before, and using that CAPM to do the estimation. And also we can use discounted cash flow analysis. We suppose that this is a constant growth model, is a golden dividend valuation model. Also, we can use in own bond yield plot the adjustment risk premium. The following slide tell you the cost of components in the capital structure. So we can have the cost of debt, cost of preferred stock, and the cost of